This is usually the calm part, the slow weeks when you check premiums. Watch inventory, maybe add a few ounces and move on. But if you could peek behind the glass right now, inside the risk rooms on Wall Street, inside the late night calls where margin and exposure get recalculated, you'd see a different mood. Not excitement, not confidence. You'd see people doing math they don't want to do. You'd see contingency plans. You'd see stress. Why? Because silver didn't just go up. It moved hard, fast enough to break assumptions. A 10% jump in a single day isn't a headline. It's a systems test. When something as basic as silver moves like a meme stock, it snaps the tidy models banks live by. It tightens margin. It forces hedges. And it drags the clearing layer, the part nobody thinks about until it matters, right into the spotlight. That's the spine of this whole machine. The clearinghouse guarantees the trade when you and I are asleep. If a big player can't meet a call on Monday because they were leaning short, the clearinghouse steps in. If the clearinghouse has to step in too far, liquidity doesn't fade, it freezes. So in this broadcast, we're going to map what that pressure looks like behind closed doors. We'll walk through the emergency playbook, margin hikes, position limits, trading halts, and the quiet rule changes that can show up right when the crowd thinks price discovery is just the market. And I'll explain why a weekend full of meetings isn't a sign of strength. It's a sign the system is watching Sunday night and hoping silver doesn't open at $85. Because if it does, this stops being about stacking a few coins for peace of mind. It becomes the weekend the market blinked. Right after that line, the weekend the market blinked, the script does something very deliberate. It locks you into an emergency broadcast frame before you have time to treat this like just another spike on the chart. The markets are closed, yes. The screens are dark, yes. The ticker looks harmless sitting there in the high minus $70s. Paused like a screenshot, but the calm is the trick. That cinematic stillness isn't comfort, it's contrast. It's the quiet hallway right before the fire alarm. Because while most people are off-grid for the holiday, the story implies the system is very much awake, not casually watching, working, calling, rerunning numbers. And the specific claim it plants is designed to hook your curiosity and your nerves at the same time, behind closed doors. Emergency risk meetings are supposedly happening at big institutions and at the highest levels of the financial machine. That's not presented as a rumor for drama. It's presented as a logical response to a single uncomfortable fact. Silver moved too far. Too fast. A 10% jump in one day is not supposed to happen in a market that's orderly. It doesn't fit the assumptions most risk models are built on, the ones that expect volatility to behave like a polite wave, not like a sudden crack in ice. And once you accept that framing, the rest of the setup becomes almost unavoidable. When a core commodity moves like that, the damage isn't limited to whoever was on the wrong side of the trade. It ripples through margin. Brokers tighten requirements. Clearing firms demand more collateral. Funds that are leveraged, directly or indirectly, start selling whatever they can to raise cash. That's forced deleveraging, and it doesn't ask permission. It spreads. It creates liquidity hoarding, where nobody wants to be the one holding risk when the math changes overnight. The genius, man, here is how the script relabels the event. It doesn't let you call it bullish silver or a breakout. It upgrades the stakes. This isn't a trading event, it's a solvency event. That single swap of language is the difference between entertainment and fear. A trading event is optional. A solvency event is existential. It says, someone, somewhere, might not be able to pay. And that is why the opening keeps steering your eyes away from the ticker and toward the plumbing. Not the headline price, but the mechanics that make the price real. Clearing, collateral, default risk. The audience is positioned as an insider in training, someone about to be shown what matters when markets stop behaving. The tweet link isn't a chart level. It's the clearing layer, the part that guarantees trades when the market is smooth, and becomes the center of gravity when the market is not. From there, the structure is already pre-built for the next chapters. First identify the fragility point, clearing and margin. Then explain how leverage concentrates risk. Then walk through what authorities and exchanges can do when stability is threatened. And finally end with what you should watch when Sunday night becomes Monday morning. That's the real purpose of this weekend framing. It turns time into pressure. It tells you the test isn't theoretical and it isn't someday. It's now. And what happens next won't just reveal where silver is headed. It will reveal whether the market is free, or managed the moment the system feels cornered. If the first section is the warning siren, this weekend is a system test, then the next step is the part most people skip. Especially people who just like stacking a few ounces and moving on with their lives. Why a metal that only moved 10% can suddenly threaten the machinery around it. Because the danger isn't the number on your screen. It's the invisible leverage sitting behind that number, multiplied and stacked like floors in a building that was never designed for an earthquake. Silver, for a stacker, is simple. You buy it. You hold it. You forget about it until the world reminds you why it matters. But the market that prints the spot price is not simple. It's a web of contracts, futures, swaps, options, where the same ounce can be referenced, rehypothecated, and effectively sold many times over. And that's where speed becomes deadly. When silver moves slowly, leverage hides. When it moves fast, leverage shows its teeth. The script's core claim is blunt. A huge amount of short exposure can exist in notional size that looks manageable on paper, until the move is not polite. Shorts can be concentrated. They can be hedges. They can be spread across institutions that all assume they'll have time to adjust. But when the market gaps higher, time disappears. A single percentage move becomes a multiple alarm problem when it hits accounts that are leveraged. Because losses scale faster than people expect. That's why the narrative doesn't treat the price jump as a headline. It treats it as a stress event that forces collateral to move immediately. And this is where the story zooms into the most important character that almost nobody thinks about, the clearinghouse. Not a villain, not a hero, more like the spine that holds the whole body upright. It sits between buyer and seller and guarantees the trade. If you buy, you expect delivery or settlement. If someone sells short, they're expected to post margin so the promise stays credible. The clearinghouse makes that promise feel automatic, until it isn't. Because the clearinghouse isn't magic. It's an insurance system with hard limits, margin first, then default procedures, and finally a waterfall of protections that ends in a default fund. That fund exists for one reason, to absorb failure without letting the whole market seize. But it's not infinite. It's a backstop, not a bottomless pit. So the nightmare scenario is simple and terrifying. A big participant can't meet a margin call while short. The market gaps higher, and the clearinghouse has to step in. If the losses keep coming, confidence cracks, and once confidence in clearing cracks, liquidity doesn't just thin out, it vanishes. Because nobody wants to trade in a market where the guarantee is questioned. That's the feedback loop the script is building toward. Gap up, right pointing arrow, margin calls, right pointing arrow, forced liquidations elsewhere, right pointing arrow, higher volatility, right pointing arrow, higher margin requirements, right pointing arrow, even more forced selling. The move feeds the stress feeds the move. And the quiet message beneath all of it is what makes this a perfect hook for stackers. Silver isn't just supply and demand in moments like this. It's a trigger that tests whether the market's promises, settlement, margin, clearing, are real when the math turns brutal overnight. And once you really feel that loop, gap up, margin calls, forced selling, volatility, higher margin, repeat, the next question lands almost by itself. Because it's the question every stacker quietly asks even if they never say it out loud. When the machinery is under stress. Who decides what the market is allowed to do? Because stacking is the slow, human version of price discovery. You buy an ounce. You hold an ounce. You're not asking permission from a model or risk committee. But the paper market that prints the reference price is a managed environment. And when that environment starts to shake, it doesn't just rely on, let buyers and sellers sort it out. It reaches for its emergency levers. That's the pivot the script makes. If clearing risk is real, then rule risk is real. And the answer it offers is blunt. When the system is threatened. Exchanges and large institutions don't improvise, they use emergency powers that already exist. Trading halts, position limits, Margin requirements that jump overnight. Sometimes the most controversial one of all, liquidation only. Where you can sell to reduce risk but you can't buy to add fuel. In plain English, that's a valve designed to choke off demand at the exact moment demand matters most. It doesn't have to be sinister to be effective. It just has to be legal. And it just has to work. The script is careful about how it sells this idea. And that's the copywriting, man. You should notice. It frames rule changes not as a conspiracy, but as crisis management. If the default fund, member stability, and the integrity of settlement are on the line, the administrators will choose system survival. That's not a moral claim, it's an operational one. In a fire, the building manager doesn't hold a vote about whether to pull the alarm. They pull it. And the audience is nudged to accept that logic by being reminded of moments when the world already watched versions of this happen. Commodity disruptions where trading was paused or rolled back. And market episodes where access was restricted right when pressure peaked. Different arenas, same instinct. Preserve the structure first. Argue about fairness later. Then comes the part that makes people uncomfortable, because it feels too real once you see it, the fine print. The narrator leans on the contractual reality that a lot of market participation is conditional. Force majeure clauses, cash settlement provisions, discretionary liquidation rights. Emergency margin changes baked into rulebooks that almost nobody reads until they're forced to. The subtle psychological move here is powerful. It doesn't accuse anyone of cheating. It simply reminds you that the system is built to protect itself, and that many participants don't understand how many escape hatches exist until the moment the exits are used. That's why this section works as a bridge. Once you accept that rule changes are plausible, routine, even in extreme volatility, the weekend meeting narrative becomes believable without needing secret documents. Because now the meetings don't have to be plotting. They can be planning. How to contain the squeeze. How to protect key members. How to keep settlement credible. And how to manage the reputational blast radius when the public sees the rules bend. And that's the big takeaway the script wants to lock into your mind before Monday. In a leveraged commodity squeeze. The market isn't just buyers and sellers. It's also administrators, lawyers, and risk committees, people whose job is to decide, in real time, what outcomes are allowed when the system starts to lose control. And here's where the story widens its lens, because once you accept that rule changes are on the table, the next fear isn't just what happens to silver. It's what happens to everything that has to fund itself every single night. This is the moment the script stops being a metals story and starts being a plumbing story. And it does it with a quiet but devastating point. Big institutions don't keep their risks in neat little boxes labeled silver and stocks and bonds. They run one balance sheet, one pool of collateral, one set of lenders. So if silver forces a margin scramble, the scramble doesn't stay in the silver corner. It spills wherever cash can be raised fastest. That's the contagion mechanism. A fund takes a hit in silver, or a bank's desk gets squeezed. And suddenly they need cash now, not next week. Not after the holiday. Cash, now. And when you need cash fast, you don't sell what you love, you sell what you can. The most liquid assets get dumped first. Credit lines tighten, and the whole system gets more defensive. That's why the script pulls you away from the silver chart and into something most retail viewers never think about: repo. Repurchase agreements. Overnight funding. The short-term borrowing that keeps the machine running day to day. If clearing is the spine, repo is the bloodstream, and blood doesn't just slow down gracefully. When fear hits, it clots. The narrative's claim is that volatility shocks make lenders suspicious. Repo lenders start asking, what's your collateral worth tomorrow morning? What's your exposure? What if this move isn't done? That suspicion shows up as higher overnight rates, stricter terms, or simply less willingness to lend. And once that starts, you don't need a full-blown crash for the system to feel tight. You just need funding to get scarce at the margins. This is where the script uses a credibility anchor. The memory of a real-world plumbing scare, the September 2019 repo disruption, as proof that even in normal times, the funding system can seize up quickly and force a central bank response. The point isn't that history will repeat perfectly. The point is that the system has a known failure mode, and it doesn't take much to trigger it when stress arrives. Then the story adds a second layer of fragility, collateral quality. Especially government bonds, because in theory, treasuries are the cleanest collateral in the world. But if bond prices are unstable, because yields are rising, inflation fears are back, or fiscal headlines are ugly, then the collateral backing all that borrowing becomes less reliable right when everyone needs it most. That's a brutal timing problem. Margin calls demand cash precisely when collateral is wobbly. And that's how you get the loop that turns stress into contagion. Institutions hoard cash. Liquidity dries up. Forced selling spreads. Volatility rises. And then margin gets tightened again. This is the section's true hook, especially for a stacker. It's the reminder that silver might be the spark, not the fire. You can stack because you like the metal, because you like the history, because you like the simplicity. But the script is saying the real reason silver matters in moments like this is what it can reveal. Whether the broader system is liquid, confident, and functioning, or whether one fast move can turn a quiet holiday weekend into a full-scale funding scare that leaks into stocks,
pressure mounts across
crypto,
the network,
and everything else that depends on easy money staying easy. And once the story has you thinking in terms of plumbing, repo blood flow, collateral wobble, liquidity freezing, the next pivot feels almost soothing in comparison. Because it returns to something silver stackers understand instinctively. At the end of all this complexity, there is still a simple physical fact. You can't print silver. You can't create liquidity out of thin air in a vault. You can't wave a policy memo and make bars appear. That's the core supply story the script keeps repeating in different ways. And it's the emotional anchor that makes the whole narrative land. Because when markets get abstract, stackers go back to the tangible: weight, purity, inventory, delivery. The writer frames the moment as an old-fashioned short squeeze colliding with a modern paper machine. On one side you have contracts, futures, swaps, options, rolling exposures forward like the calendar itself is a solution. On the other side you have a finite commodity that has to be mined, refined, shipped, insured, stored, and actually delivered. Those two worlds can coexist for years as long as confidence stays high and most participants are happy to settle in cash or roll positions. But the script argues that the danger shows up when the mismatch becomes visible. When too much silver has been sold as exposure compared to what can realistically be delivered in the window that matters. Not eventually, not in theory, in the real world, at real warehouses, with real lead times. That's where finite asset logic becomes different from a typical squeeze story. With a stock, you can debate float, liquidity providers, share creation mechanics, and borrow rates. With silver, the backstop is physical reality. Mining doesn't ramp overnight. Refining doesn't double next week because the price popped. Shipping and fabrication have bottlenecks. Industrial demand doesn't politely pause just because speculators got loud. So if shorts need to cover into a tightening inventory environment, price can move violently for a very boring reason. The necessary buying cannot be satisfied cleanly. There isn't enough for sale at the price that makes everyone comfortable. And time becomes the enemy. This is also where the script quietly raises the stakes beyond profit and loss: credibility. If the paper price, what you see on the screen, fails to reflect physical availability, the market risks a split, a decoupling, a world where silver on a ticker is one thing, and silver you can actually buy, take delivery of, and hold is another. That's why the narration keeps returning to the same punchline. A quote can be maintained. The metal cannot be conjured. You can manage optics. You can't manage atoms. And this is the section that gives the story its almost historical tone. It's not just, silver is up. It's the return of hard constraints to a system that's gotten comfortable with synthetic abundance, numbers that can be rolled, netted, offset, and financed indefinitely. In that framing, the violent moves aren't irrational. They're what happens when a leveraged paper structure runs into a finite commodity and discovers, very suddenly, that reality doesn't settle in cash. And once you accept that silver is a finite asset, and that the real risk is the gap between paper claims and physical availability, The next move in the script is almost inevitable. It asks where real price discovery goes when one venue tries to manage the optics. Because if the West tightens rules, hikes margin, or nudges the market toward cash settlement, the pressure doesn't vanish, it looks for an exit. And that's where the story introduces a wedge that feels both technical and cinematic at the same time: Shanghai versus New York. Here's the idea in plain terms. The way a stacker would feel it: if you can buy silver on a screen at one price, but you can sell real bars somewhere else for more. Metal starts moving, not because of ideology, because of arbitrage. The script frames it as a pressure valve the system can't fully control. Western paper centers can slow the buying pressure with administrative tools, higher margin, position limits, trading restrictions, even settlement changes that reduce the incentive to demand delivery. But physical demand doesn't take orders from an exchange memo. Real buyers bid for real metal. And if that bid is stronger in one region, especially a region that's more comfortable with immediate physical settlement, then the market doesn't debate. It routes. That routing is the trap. Because the more the paper price is capped, the more attractive the paper price becomes relative to the physical bid elsewhere. The screen turns into a bargain, cheap silver on paper, and that bargain accelerates the drain. Bars flow toward the higher bid, inventories tighten where the price is restrained, and the mismatch gets worse over time. In other words, attempts to stabilize the quote can unintentionally destabilize the vol. The script uses Shanghai as the symbol of this dynamic, but the deeper point is about competing settlement cultures. One center can tolerate synthetic supply as long as it can roll, net, and cash settle. Another center puts more weight on delivery and immediate clearing in the physical market. When stress rises, the market starts favoring whichever venue looks more real. This is also where the narrative shifts from banks versus shorts into something bigger: market centers competing for credibility. If physical prices in one region climb above paper prices in another, the benchmark itself starts to look questionable. And once the benchmark is questioned, you don't just have volatility, you have a legitimacy problem. Because a benchmark isn't powerful because it's printed on screens. It's powerful because people trust it to represent reality. Decoupling is what happens when that trust cracks. The market becomes two-tier. Paper quotes for trading. Physical clearing prices for anyone who actually needs metal. For a stacker, this is the part that hits quietly. Because it's not about heroics. It's about incentives. If decoupling shows up, it will look like premiums that won't come down, delivery times that stretch, and a growing gap between what the ticker says and what it costs to actually get ounces in your hand. And that's why the script treats this weekend as an inflection point, not just for price, but for power. Because when trust breaks, the real question isn't, how high can silver go? It's who gets to decide what silver is worth, and where that decision is made. And if the market really does start to split, paper quotes here, physical clearing prices there, the next battleground isn't just warehouses and vault reports. It's your screen. Because when credibility is at risk, the fastest tool any institution has isn't a bar of silver. It's a story. That's why the script warns you to expect something that feels almost boring at first. A coordinated messaging wave that arrives right on schedule. Usually when the public is most distracted, Sunday night, late holiday weekend, just as futures begin to trade and everyone refreshes their feed. This is narrative warfare. And the clever part is how quietly it operates. You won't see a memo titled "Control the Public." You'll see calm headlines. You'll hear phrases that sound responsible: orderly markets, volatility being monitored, liquidity remains sufficient. You'll get expert commentary that frames the move as temporary, technical, or emotional, anything but structural. And the point isn't necessarily to lie. The point is to shape behavior. If enough people believe everything is fine, fewer people rush to buy, fewer people demand delivery, fewer people pull liquidity from the system, and the institutions running the pipes get time to reposition. Time is the most valuable commodity in a squeeze, and messaging is how you buy it. For a stacker, this section lands differently because stacking is already a rejection of narrative dependence. You're not buying silver because a talking head told you to. You're buying because you like the idea of something real, outside the feed. But the script is saying, even if you stack quietly and don't trade, what the public believes still matters. Because belief drives flows. If the crowd is convinced it's a speculative frenzy, they'll hesitate. If they're convinced it's social media hype, they'll dismiss the underlying constraints. And if they're convinced the system is stable, they'll stop looking at the places where stability actually shows up: premiums, inventory, delivery terms, settlement conditions. Notice the copywriting. Man, here, the narrator doesn't need proof of a backroom plot. He only needs to point to patterns the audience has already seen in other moments of stress. The urge to calm, to reframe, to redirect blame. It's retail, it's meme traders, it's geopolitics, it's a one-off. Those explanations may contain pieces of truth, but they also serve a function. They keep the spotlight off leverage, off concentrated short exposure, off the fragile plumbing that breaks when prices move too fast. And once the audience accepts that this kind of spin is plausible, the script inoculates them. Sunday night headlines stop being information. They become signals, part of the battlefield. Structurally, this is also a retention move. It tells the viewer, if you hear calming headlines tomorrow, don't relax, expect them. That keeps the emotional tension alive long enough to reach Monday. And it preserves the central hook. You're not here for the surface narrative. You're here for the mechanics beneath it. Because in a crisis, the market doesn't just trade in ounces and contracts. It trades in confidence. And confidence is managed, one headline at a time. And once you've been warned that the headlines can be part of the battlefield, the script does something smart, because fear without a plan doesn't hold attention for long. It hands the viewer a dashboard, not to make you feel like a day trader, and not to turn stacking into a frantic hobby, but to give you something solid to watch when the market reopens and everyone tries to tell you a different story. The message is simple. Don't stare at the silver ticker like it's the whole truth. Watch the instrument panel, because Monday isn't just a price open. It's a systems test. The first light on that panel is gold. Not because gold leads silver every time, but because gold is the broader signal for precious metals trust. If silver is ripping while gold is flat or sliding, the script frames it as a different kind of move: more squeeze, more plumbing, more localized stress. But if gold confirms, if it's bid with strength, then the move starts to look like a bigger repricing. A shift in confidence, not just a cornered trade. Next is the US dollar. A firm dollar can dampen commodities and tighten global financial conditions. A weakening dollar can add fuel to metals and make the whole inflation narrative louder. Then comes oil, the master commodity. Oil isn't just energy, it's a cost input that bleeds into everything: transport, mining, manufacturing, and when oil jumps, inflation expectations can jump with it. And finally, Treasury yields, the quiet heartbeat of the whole funding structure. Rising yields can mean bond stress, tighter financial conditions, and collateral sensitivity, the kind of environment where margin becomes more painful and liquidity gets picky. The script's underlying claim is that these aren't random charts. They're indicator lights. If multiple lights start flashing at once, gold confirming, dollar weakening, oil rising, yields spiking, the odds increase that silver's move isn't a one-off spike. It's part of a broader repricing driven by liquidity and confidence. And that's where the levels matter. 2. Not because this is a chart class, but because markets are wired with triggers. Certain psychological prices and technical breakpoints can ignite algorithmic buying, force short covering, and accelerate the very loop the script has been describing. In a squeeze environment, levels aren't lines on a screen, they're tripwires connected to margin, risk limits, and automatic execution. What makes this section effective, especially for a stacker, is that it turns anxiety into observation. You don't need to trade the open to understand the open. You just need to read the dashboard. Because if emergency measures were applied over the weekend, Monday will show whether they worked in the only way that counts. Did they restore orderly trading? Or did they merely delay the pressure and push it into other channels? That's reflexivity, the script's quiet engine. Silver can force liquidity demands that hit other assets.